welcome to another week of WWM Talks. Today is December the 11th, Thursday, and I'm here with Vince Stefano and Greg Carroll. As you notice, it's just the guys this week.
The three amigos.
Yeah, the women seem to have the month off, isn't it?
Apparently.
They're cruising.
Everyone's cruising, yeah.
Everybody's cruising.
I'm jealous.
Anyway, this has been kind of a flat week in the market. I don't have all the statistics for 1 week. I'm not sure it really matters all that much, to be honest with you, 1 week. But it seems, Vince, you probably have a better take on that.
Yeah, the week is, like you said, it's been flat. But more importantly, when you look at year to date, I think that's more important. Right now, year to date through yesterday, the NASDAQ was up 22.1%. The S&P up 16.3%, the Dow up 11%, and the Russell 2000 up 13%. So,
you know, when you talk about the indexes being up, though, I know we've talked about this before. If you weren't in the big companies, especially the Mag 7 type companies, your return could be much lower than that.
Yeah, and what's surprising is, the Dow. I mean, the Dow's up 11.8, and it's up another 1% today. So think about, the Dow typically isn't a index that surges, but it's been doing pretty well recently.
Well, I want to clarify the Mag 7. How many are actually beating the S&P this year?
How many of the Mag 7
are outperforming the S&P year to date?
Maybe not a lot, but
two.
Yeah, but in the first half of the year, they were outperforming by a lot. It's been in the last few months that the others are starting to catch up.
The other 493, you mean?
Yes.
Yeah. Okay.
And let's say there's maybe 480. There's about 20 stocks that have really, look, the S&P and NASDAQ, they're weighted. So the bigger the company, the more that has an effect on the index.
Yeah.
So when you get these companies that are huge and they make a move, that's going to cause the index to move a lot more than the 500th company, which is less than 1% or who knows what it is.
Right, but if they're underperforming the index, that they're not having, an outsized move on that. It's actually held it back in that sense.
Not in the last few months, but it's cumulative.
Right.
So the first 6 months or so, 7 months, they were carrying the load, and they have been for the last couple of years.
That is true.
Now, I think you're correct. Now you're starting to see some...
I'm correct.
I know. You're always right. I'm not sure why I'm here. Greg, you just do it here.
Okay. Another interesting statistic on the markets is, what's at all-time highs? Not the S&P, but the Dow Jones.
I just said,
the Russell 2000, and the equally weighted S&P 500, where all the stocks are, same percentage weighting, is at an all-time high.
Which again goes back to what I'm saying, that over the last couple 2-3 months, that has made the surge.
Yeah.
So, and that makes some sense.
Are we at a turning point?
Well, I don't know. Maybe. That makes some sense because with interest rates coming down and the Fed just decided to lower interest rates by another quarter point, the smaller companies are more advantaged by that. So I think that's what people are kind of looking ahead to. And everyone is scared to death that this is a bubble like the year 2000. I would argue against that.
And with the AI stocks, not necessarily all the market, but with the AI stuff, I think is what the talk is.
Well, you have to remember when you look at the Dow, and again, it's weighted a different way. But when you look at the Russell 2000, a lot of the Russell 2000 is in smaller financials and smaller energy companies. Mm-hmm. And so some of the oil stocks have actually done pretty well this year.
Yeah.
Not all. But as these rates keep coming down, these small financial companies have done incredibly well, and that's really boosted the Russell 2000. And you're starting to see a lift in some of the biotechs because, again, they've been underperforming for the last 3 to 5 years because of higher rates. Once rates start coming down like they have, you'll start seeing some of those do better.
Well, and also, we didn't mention this, but the mergers and acquisitions market has really picked up.
Yeah.
So there's another reason why some of the Dow stocks, perhaps, some of the larger financial companies and the S&P, which they're also in, is causing that to catch up to where the tech stocks were, because with increasing M&A, mergers and acquisitions, the financial companies should be making a lot more money. So that makes sense.
Makes sense. Yeah.
And I think the AI bubble or whatever it is, what they're doing is spending these massive amounts of money and building these data centers and infrastructure and all that stuff, which is some of the Dow stocks, some of the Russell 2000, they're actually, the recipient of all that cash, and maybe that's helping them out a little bit too. So if the AI stocks can keep spending like they are, maybe it lifts all boats.
Well, eventually that spending is going to stop.
Yes.
Or certain not stop, but it will definitely slow down. But there's an arms race going on right now. All these companies need to stay competitive.
Yes.
And so they need the chips. So that makes some sense. But at some point, and maybe you ask about a turning point. I actually think we're kind of in the second phase of all of this. Remember, there are companies that have made thousands of percentages over the last 2, 3, 4 years that are, in the AI business that make the hardware. But now there's companies, I think, that are coming up. I know, Vince, you probably going to talk about this.
I was going to mention that because I've been talking about 2026, and we're at the end of 2025. So, over the next couple of weeks, we're going to get into the holiday season, Christmas, Hanukkah, New Year. Everybody's gone. They're down in the Caribbean. They're in Puerto Vallarta.
Or you're in Puerto Vallarta.
But, and I'm saying that, what you'll probably see, even though it's a seasonally strong period, you'll probably see another maybe 1.5% to 2% at best in some of the indices. So, that's it. But what you really have to, and I think everybody's focusing now on 2026, and I've been saying this in the last, couple of podcasts, I think you're right. I think we're in the midst of a big spending boom. And the reason is businesses are spending on 3 very big stools. Number 1 is structures, and that's factories, warehouses, and data centers. Number 2 is equipment. They're spending a tremendous amount of money on industrial machinery, servers, and tools to produce goods and services. And finally, they're spending a lot on intellectual property, and that's the technology, because they need the technology to spur R&D and innovation. So I think you're going to start seeing more and more money flow into the economy because of this business spending. Also in 2026, I'm also thinking you've got the tax incentives are going to start kicking in starting the first of the year. When you look at the one big beautiful bill, you're going to start seeing tax rates start coming down. Business regulations are also going to be, in a point where they're decreasing. That's going to be good for business spending. You're going to have no tax on tips, no tax on overtime, no tax on Social Security, which is going to provide more money for households. That should be good for overall personal spending and better for stocks.
Is that for sure that there's not going to be tax on Social Security? Because I thought that was not the case.
It is not the case. There's a new what do you call it? Deduction, a reduction of an exemption for part of your Social Security. But it's not all.
And isn't it for lower income people?
It does phase out at higher incomes,
right?
For sure.
Which is the other thing I always laugh about. Everyone says that Trump's policies really favor the rich. Almost every single one of these policies do not.
They
kick
phase
in for the
out.
rich.
Yeah.
But the only thing that I can think of, I'm sure there must be more, is the when you die and people inherit. There's a higher threshold for that, so there's more money. Other than that, almost every one of these policies is advantageous to people who are in middle and lower income.
So again, I think that's going to help. I think anytime you have more money in people's pockets, it's good for the economy.
Sure.
And lower interest rates, what's it going to help? It's going to help housing. And if we can get housing affordability down, I think that's going to be very good. So I think 2026 is going to be a very, very good year for the stock market. And again, I'm very optimistic for next year.
So if the bigger companies that are highly weighted in the averages don't do that well, then how will the stock market in general do well?
Well, I think the bigger companies are going to do well. I think that's where you've got some of the biggest innovation going on, because they've got the money to continue to spend on innovation and R&D. And when you look at who's building these massive data centers, who's going out and developing the increasing power generation, it's these big companies. It's the big tech companies. It's the big industrial companies.
They're spending all the money, but it's the smaller companies that are beneficiaries of that.
Well, that's what I'm saying.
They're
That's why
paying them.
That's
to do
why
that.
I'm saying,
Yeah.
these big companies can spend money, and it's almost like
Right.
they lift all the boats. And you
Trickle
might have been
down
saying
there.
that
Yep.
earlier.
Yes.
I thought I heard you say something about that. But I think that next year is going to be a really good year, and I've been saying it all along. The second half of 2026 and into 2027, I think the market is going to do. You're going to have a melt up in the stock market, and people have to be there. And I tell you, 2026 is going to be an interesting year because of the midterm elections. And if all of this stuff works well, I think that it's going to be a real interesting November.
Well, yeah. Let me just say this. I don't know what's going to happen in 2026 as far as the stock market's concerned. Every time we think we know, we're hit upside the face.
I could be. I probably will be.
Yeah.
Something we didn't see coming.
So, to say that there's going to be a melt up, maybe there will, maybe there won't. But there are certainly, I will say this has become more of a stock pickers market, I think, or it will be more of a stock pickers market than just buy the index and hold.
Yeah, I think the FOMO of missing out on the Mag 7 stocks, and like I said, there's only 2 beating the S&P right now. People need to get over that and do some other stock picking. There's a lot of great companies. The financials, industrials, obviously are doing very well. So
the energy stocks,
yeah. I mean, we've got to power all these data centers and stuff. So we got to produce a lot of energy. I think that's the broadening out.
That's actually a big bottleneck right now. I mean, we don't have enough energy
right.
The energy need is skyrocketing. I mean, skyrocketing, and we're still stuck in this old electrical grid.
Yeah.
So, you've got companies out there that are innovating and hopefully will come online within the next year or two. Otherwise, I don't know how we're going to continue to do the, continue to advance with the AI.
Right. To power everything. It's going to be tough.
Powering, cooling systems. I mean, there's a million things I think that are, and that's the other thing too. Everyone tells me that, AI is going to take out all of people's jobs. We'll never be able to work again, because AI will do it all. And yes, there are jobs that are going to be replaced without question. And in the beginning of every revolution, like the economic revolution in the late 1800s, that happened. The people who were shoeing horses didn't have a job anymore because cars took over.
Right.
And that happens. But then there are new businesses, and there's new businesses we're not even thinking about, but we just talked about. You have more cooling needs, you have more energy needs, you have more financial needs, you have more of a lot of things.
Right.
So I hate it when people just sit there and bemoan, oh my God, this is the end of the world. Yeah. We're in a bubble. I wish I had $100 for every time somebody told me we're in a bubble. I would be a millionaire. So
bubble's not a real good word, but
it's really not. I mean, look, in the beginning in the 2000s, beginning of 2000s, excuse me, the real problem was that those companies weren't making money. The companies today that everyone says are in a bubble, yes, they're spending a lot of money, but they're making gazillions of dollars.
Yeah. They're making huge amounts of money.
But they are starting to borrow some money to keep this spending going, which is something that we need to keep an eye on.
Not every company, though.
Not everyone.
Not everyone. But if you look at the big tech companies, you look at their debt to revenue, and profitability. There's only one company out there that has a 4% debt to profitability ratio. Everybody else is around 0 to 1%.
Yeah.
And unfortunately, that company.
No, they're very, very strong. Yeah. But it's something that's starting to creep in as they start to borrow some of the money to keep these astronomical spending increases going each year. I mean, it's numbers that we've never even heard of before.
Yeah, and I don't know if it's going to continue, but I can tell you this: another thing that is kind of interesting, and it goes to the market itself. There was something I saw in the Wall Street Journal. At the end of the third quarter, Americans that had 401ks, 654,000 Americans were 401k millionaires. Think about that. That's a lot, a lot of money. So
going to that though, I also heard that the average, the median was something like $130,000.
Well, yeah, it could, yeah. But think about where the spending comes from. It comes from the very top echelon of people. So, you've got these people that are now 401k millionaires, and I would say, and all of this really growth in these 401ks came through the stock market. And what we're now saying, they did a study where people in their late 30s and early 40s, 88% of their 401k is allocated to equities. So that's interesting because these people are taking advantage of, the market. And, younger people are saying, hey, I want to be invested in the market because right now they can't get invested in real estate in the housing market because it's too expensive. And, hopefully that will change over the course of the next couple of years. But it won't only be lower interest rates. There has to be some government, state and local government regulations that, get rid of some of this, some of the crazy stuff where people can't build houses. They've got to get the permitting down. You can't have, just crazy permitting.
Housing prices can't come down until they start building.
The permitting policies have to come down a little bit for that. So anyway, it was kind of interesting when I saw that. I thought, wow, that's pretty interesting. So anyway, that was just an aside.
Excuse me. I was reading something about inflation and what causes it, or what is causing it lately. And the top drivers have been housing, food, energy, cars, and services. This is a breakdown in the last 10 years, between 2015 and 2025. I got this from ChatGPT, so you can argue with them if you want.
I don't argue with ChatGPT.
Insurance should be in there, I would think.
Well,
that's probably cars too, I think.
It is. But as far as housing is concerned, it says rent plus owner's equivalent rent is the biggest and most persistent driver of inflation. And it said that between 2015 and 2019, inflation was up about 3 to 3.5% as far as housing was concerned. Between 2021 and 23, I wish I could speak here. Between 21 and 2023, it surged to 6.8%,
Wow.
The highest in decades. And in 2024-25, it's cooling, but it's still 5%. Okay, and I was thinking about that. Why is housing still so expensive? And I think part of it is that we had rates at zero. Okay, so people were getting mortgages at 2%, 2.5%. They don't want to give that up.
Right.
So the amount of houses that are out there to sell are diminished. So the people who want to buy are now competing for fewer goods.
And the permitting won't allow building of
But
houses.
we just haven't built enough houses to keep up with the growing population is one of the biggest reasons.
Well, exactly. And matter of fact,
it compounds the problem when people don't want to move because, gosh, I got a 2%. I'm not going to go pay 6% now. It's hard to give that up.
Well, one of the things that ChatGPT was saying, housing alone kept inflation elevated even after other categories cooled.
Mm-hmm.
Now, food is another one we talk about. And it said it spiked sharply during the pandemic and stayed high. Between 2015 and 2019, food inflation was up about 1 to 2%. In 2021 to 22, it jumped between 7 and 11% because of supply chains, fertilizer costs, labor shortages, etc. Then 2023 to 2025, it's cooling, but it's still somewhere around 4%. But prices are remaining high. And part of the reason for that
I think you got to say that right, too. It's cooling. It's just growing fast or slower, but it's not coming down.
It's not coming down.
Yeah, that's what a lot of people think when you say it's cooling. Well, prices are coming down. It's not just the rate of increase is what's slowing down, but still quite high.
But it said the biggest problem, or the biggest reason, and I'm going to say it's a problem, is restaurant prices because of labor. The labor costs have gotten so high that they have to raise their prices. It's interesting too because I was just at an event and I was talking to somebody who used to be the CEO of a public restaurant stock, and we were talking about one that everyone knows about locally. I won't say the name because it is a public company, but in one day after they decided to raise the minimum wage to $22
an hour
in California.
Yeah.
This particular restaurant closed 48 stores in California alone.
Wow.
Okay, so this has been by far the biggest driver of increased prices.
Right.
So I always tell people that raising minimum wage doesn't necessarily make people wealthier because all it does is add costs to the restaurants or to the whoever it is.
What was the rate 10 years ago for minimum wage was probably like $8. In California. So they've more than doubled. And you wonder why prices are going up. It's not just the products, it's labor.
Right. I mean, you go to even a fast food restaurant today and you're paying, I think I went to
You don't get a $1 meal anymore, do you?
No. Well, you get one French fry for
$1. You get a French fry?
But I went to McDonald's recently, and I think I paid around $13 for the burger, drink, and fries. And that just a few years ago was $8.
Yeah, that's a lot of money when you think about it. Yeah.
And a lot of restaurants are having trouble. And that's the reason. Yeah. So, because their costs have just gone up astronomically.
But what else are they doing to combat that? Like McDonald's is AI, electronics. You don't see the people coming out to take your order anymore, right? You got to go to the kiosks, right?
Yeah, and a lot of restaurants you get smaller burgers.
Shrinkflation.
Well, no, that's not true. But and I'm not just. And
I don't know about that.
My quarter pounder is really not a quarter pounder.
And I'm not just talking about McDonald's. I'm talking about all of the of the restaurants. This is about McDonald's, and I think that the fast food industry right now is a tough industry to invest in anyway. So, but another thing for as far as inflation is concerned is energy, gas, electricity, and natural gas. This has been, of course, the most volatile sector, which it normally is. Between 2015 and 2019, it was pretty well flat or negative in some years. In 2021, gas prices surged 50%. In 2022, another spike due to the Russia-Ukraine war. And then 2023 to 2025, it fell, and became deflationary component. Yeah. So the impact really was energy spikes caused a sudden jump in CPI, Consumer Price Index, in 21 and 22, but cooling energy prices have helped bring inflation down in 2023 and 24. You guys were talking about cars, new and used vehicles. Used cars, in 2021, they soared 40 to 50% due to chip shortages, according to ChatGPT here. Between 2023 and 25, prices fell but remain above pre-pandemic levels. With new cars, in 21 and 22, it increased 10 to 13%, inflation did, and now it's stabilizing in the low single digits. So that was another reason. I've got just a couple of others here. And by the way, that was the single most abnormal category in recent inflation history.
Autos?
Yes.
Oh, wow.
Another one, services, travel, medical, insurance, and labor-heavy sectors. And this is where I think people are really feeling it. Okay, it's the sticky part of inflation. Between 2015 and 2019, inflation was up about 2 to 3%. In 21 to 24, it accelerated to 5 to 7%. By the way, that 21 to 24 period was pretty bad. Okay, and then as far as inflation is concerned, then 2025 we're still there. We're still at about 4 to 5%. And the why to this is wage increases across service industries, which we talked about, higher insurance and medical costs, and strong demand for travel and leisure post-pandemic. And this is the main concern for the Fed right now, according to at least ChatGPT, that services inflation moves slowly and rarely goes down. Yeah. So, inflation is here, and it's hard to get it down. I mean, and when the economy itself is doing okay, right?
No, it is. The economy is doing. Yeah, I think the economy is doing very well right now. I think it's going to do a lot better in 2026.
So that makes it a little bit harder for the Fed to say, well, let's just keep cutting and cutting, because that could trigger a huge inflationary spike.
Right.
But I do think that Powell has been slow to the game, just like he was slow on the other side. So, but he's not going to be here much longer. Trump will definitely get rid of him. Well,
he'll get a dove in there that will pressure rates down more.
If you're seeing, GDP growing at 3.5 to 4%, and then possibly growing above 4%, that's strong. I mean, that is, that's going to help all sectors of the economy. I mean, think about it. I mean, if you got that GDP growing like that, everybody's going to benefit from something like that. So,
well, the gross domestic product, which is GDP, has been running at about 1 to 1.5%.
Yeah, the last few quarters, though, it's been in the threes.
Well, I think that every administration, not just this administration, would like to see that at higher than 1 to 1.5%.
I think you will, too. And, you're going to see, I think, a lot of onshoring of manufacturing. You talked about, cars. I mean, I think, if I'm correct, I think there's going to be, you're going to be able to deduct the interest on your auto purchase now. So
I don't know. Rachel's not here.
Rachel's not here, so I can't.
Yeah, I don't know if I've heard that one, but
I thought I heard that. But again, that could be very interesting. You're talking about the immediate expensing of capital equipment for businesses. Now it's going to be, they can do it in 1 year. That is huge. You're going to see more tax credits. Energy, you're going to see more tax credits.
That's going to help businesses a lot.
And energy subsidies, you're going to see a lot more. So I think that's going to help. And again, we were talking about permitting. you're going to see more streamlined permitting in 2026.
Right.
And I think that's, pro-business is going to increase their investments in projects. And so, again, I'm very optimistic for 2026, 2027.
Well,
Yet the fear and greed index is still in the fear category. The
Really?
CNN fear and greed index is at 40, which is close. 45 is neutral, 45 to 55. So it's getting close to that neutral mark. And you can see the volatility in the stock market has slowed down a bit. I don't know if that's because of seasonality or not.
I think it was a Fed meeting yesterday. I think the volatility is going to pick up a little bit again.
Well,
so?
it was kind of interesting. Early on today, we saw tech stocks get hit really, really hard. And when you went down the list of tech stocks, you saw them all down, 2%, 3%, 4%. Maybe you had an outsizer that was, a little higher than that. But what that kind of says to me is this was algorithmic trading in technology stocks. When you get everything around that in that small band, those are just computers that are, kicking the stocks out. It's not a qualitative hand going in there saying, oh, the fundamentals of all these stocks have changed so dramatically, I have to sell them. No, it's a computer. Some guy's on the button going, that's what he's doing, and they're all in that band. So anyway, I think that, again, I think, look at technology is going to be the creator of everything we want over the next 3 to 5 years.
So I can put you in the bull category then for 2026. Is that right?
I am.
Is that for technology or the market, the broader market?
No, the whole market. Yeah. I am very, very optimistic. Yeah. I'm very bullish on 2026 and 2027.
Yeah.
Because I think there's going to be so much not only interesting stuff, but I think you're going to see profits and revenues of companies really increase dramatically.
Well, let's hope you're right. I mean,
dramatically starting in the second half of the year, but the market's going to forecast.
I don't know if I agree with that. We got midterms coming up next year, and if they don't start getting some of these prices down, and you already see some of the tariffs rolling back, the Democrats are going to take over the House, and that would slow a lot of these, pro-business type of, programs, I think, a little bit, and the market, could stumble on that.
Yeah, but okay, but let's go back. I mean, under Republicans and Democrats, the markets have grown. Okay, so
right.
I don't want to just blame one side or the other.
Oh, I'm not blaming one side. I'm just saying what he's saying is all these pro-business programs are really going to help the market and companies, which I agree. But if the midterm elections flip the
right.
majority there, I do think that there will be some. It won't be as rosy for business.
Well, in the elections we've seen, I don't think are actually pro-Republican or Democrat. They're pro-socialism, and I know we've talked about that a little bit, and it does scare me. I know I won't talk about it much, but it does scare me.
Well, I think that there's going to be a reality check for New York that you just can't give everything away because you got to pay for it.
Right.
Someone's paying for it.
There's no such thing as a free lunch.
There isn't.
We know that.
So, and that's like every campaign. It doesn't matter who you are, socialist, Democrat, Republican. You campaign on all these promises, and then you get in there and you're like, oh, it's a little harder
You're right.
to get it done.
So, and we talked about something here before we started this podcast, and that is this is one of those years, I think, that people have taken some profits. Okay, there have been big profits in some stocks, and people, the investor is going to see, oh my God, I've got a big tax bill. All right, but when a stock goes up by 300, 400, 500, 600, 700, 1,000%, and you take some off the top, it means you've made a lot of money.
Yeah.
Okay, so I know there's going to be people at the end of the year say, I can't believe I'm paying this much in tax. All right, so I want those people, especially if they're our clients, to realize that, you're paying a lot of tax, but it meant you made a lot of money.
There's worse problems to have.
Right. If you don't like how much you're paying in tax, then make sure your congressman will get taxes down. That's nothing we can, that's the price of playing the game.
Yeah.
So.
I agree with that 100%. You can't manage a portfolio strictly around taxes. I know people say they can, but it's very, very difficult because,
Well, not strictly around it. You can do some things.
Yeah, there's ways to strategize.
What I'm saying is there are many. How many times have you bought a stock? It's gone up. You don't want to sell it because you don't want to hit your client with taxes. And instead of being up 100%, all of a sudden by the end of the year you're up 30%, and you're like, why didn't I take that 100% profit? And you want to look good. Everybody wants to look good. Otherwise, you got splaining to do.
Vince, I thought I already looked good.
You look beautiful. But here's the deal. Here's the thing. When you're out, the biggest drivers of the market are institutions, mutual funds, and these big hedge funds, and they don't give a rip about taxes. Right. All they care about is performance, and they want to make as much money as they possibly can for their clients. Right. And so that's why when people say, oh, I'm worried about taxes, no, worry about making as much money as you can, because there are ways to offset it. You'll have some losses or something, and you could offset it somewhere else, or make a big donation. Make a big donation to a charity and have a dollar-to-dollar write-off or something. I don't know, but you could do something to offset taxes.
Yeah, I don't know if it's dollar for dollar, but it is a deduction.
Yeah,
but it means you're spending your money. So
you made a lot of money. I mean, you might be one of those 401k millionaires.
You mean other than you?
Well, I don't know. I'm looking at you and Greg. If I had half your money, I'd burn mine.
You keep promising.
Haven't heard that one in a while.
All right. Anything else you guys want to talk about?
I think that's all I've got right now.
All right. Well, we will be back again next week, and the girls, the women, the professional career people will be back here in, I think, next Thursday, right?
I believe so, yeah.
So today is the 11th. That'll be the 18th. And let's see what happens in the marketplace. And Vince, I hope with all of my heart that you are right, that 2026 and 2027 are going to be great years.
I hope so, too.
So, that if that's the case, then you don't have to burn all your money.
I won't.
All right. We'll talk to you guys next week. Until then, happy investing.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only, and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.